Before starting, just want to say thanks again to our speakers for being here. Like Josh said earlier, we kind of set up this multifamily forum to provide a real expert opinion that we could learn alongside of our investors, and really did a great job. Appreciate our speakers for being here. I'm going to talk a little bit about our investment thesis on the acquisition side, and then I think Cassie's going to talk for a minute about our development plans and kind of what we're looking for on the development side. As we've heard from our presenters, and I'm going to try not to just reiterate everything that they've already said, but as we've heard from them, we have reached an interesting spot in the cycle. Now, on the acquisition side, with interest rate increases and seller pricing not decreasing to meet that increase in interest rates, and then also a situation where there's not a lot of good alternative investments for current real estate owners. Issues with replacement properties really not being available and not being able to duplicate some of the returns they're getting on their existing real estate. We've seen sellers back out of the market a bit as well. And so it's really created a situation where it's harder to find really good assets. And as everybody here knows, Metonic is a pretty patient buyer, and we like to make sure we're buying the right things. We've got very patient equity and very patient investors. And so it's been a little bit difficult to find the really great investments that we typically look for. Now, that said, we are still looking for great assets every day. We're still big believers in our business plan. We still are bullish on multifamily. We're very bullish on the Midwest markets and markets that have similar fundamentals to the Midwest. We're still, looking at long-term hold and generational wealth building through ownership of real estate. I'd like to hear Justin and our acquisition team say all the time, really, apartment fundamentals are not broken. What's really broken is capital stacks. And we've seen a couple of situations where capital stacks are causing some problems for existing owners. And as Jay kind of said earlier, a big part of that is people who have over-levered in the past and people who have put short-term and variable rate debt on deals. And that's going to create a situation when all that debt comes due where they're going to be in a position where they may have to be cash in on a refinance, which is a situation that every investor tries to avoid at all costs. And so thinking there'll be some opportunity as a result of that. And the other thing that we've seen recently is some capital is pulling out of deals. And so we've been contacted by a number of different people over the last few weeks who are either looking to buy property that's currently under contract, or more commonly looking to develop ground that they own that they've had their capital pull out of, and have called us asking us to help step in and find a way to help them raise the capital. And we think that's going to give us some opportunities to find some really good real estate that, we can step into that I think will be a good opportunity for us. And then we've also been hearing about commercial lenders backing out of the market, proceeds, coming way down on loans, much harder for sponsors to get debt, particularly sponsors that don't have a lot of experience, don't have a track record, and don't have guarantors that will allow them to take on that kind of debt. And so we think we'll see a little bit of a reduction of other players in the market, which is another thing that would be an advantage to us as well. And what we're really looking for right now is really good product that has either assumable debt, fixed rate debt that we can assume. A lot of times we're able to buy a property that's got an existing loan on it, or structures that will allow us to de-lever the loans quite a bit in order to take advantage of some liquidity opportunities if and when the market turns back around. But both of those strategies do require more equity to come into deals. And so we feel like we're well positioned for that. We've got a great investor base who, has been loyal to us and has followed us in deals, and we think we can raise the equity we need to be able to do that, where a lot of sponsors aren't willing to be able to. And so we think that gives us a positive advantage in the market. The other thing we're really looking to do is expand our markets a little bit. We're still looking at Midwest markets, still looking at markets that are similar to the Midwest markets, but given the lack of supply, extending those markets and expanding those markets is going to be important. And we heard Jay talk a lot about oversupply and supply coming into the market with exceptions. And what we're really looking for is those markets where those exceptions exist. And we think we've got a lot of those, in our existing portfolio. We're also looking at new markets potentially. generally look for markets that will have 5% or less of its current inventory under construction, and markets that are 95% plus occupancy. A couple of examples of that. So Omaha right now, even though it looks like there's a lot of construction going on in Omaha, is under 3% of its current inventory is currently under construction. Kansas City is also right around 3%, another market that we've been looking at. Springfield, Missouri, which is one of our really great markets that we've been in, is also historically been around 3%. But then when you look at some of the larger, faster growing markets that are in that hyper supply cycle, the Austins, Phoenix, those are, closer to 10% of their current inventory is under construction. And so we're trying to avoid those types of markets. And also trying to find markets where rents and occupancy are still increasing. There's a lot of markets where that's not happening. And what we really don't want to do is be in a position where we're trying to buy in a downturn market and trying to time the bottom to be able to kind of take that back up, but rather looking in markets where there's still growth in rents and still current occupancy increases. And again, Omaha has had almost 4% rent increase over the last 12 months, which is one of the highest in the nation. I think Yonaton said it might even have been the highest in the nation over the last couple of months. And occupancy is still under 5%. Vacancy is still under 5%. So really strong market. Kansas City has had 3% rent growth over the past 12 months. Springfield, Missouri, 3.5% rent increases. But Phoenix has been negative 2% over the past 12 months. Las Vegas has been negative 2%. Atlanta has been negative 3%. So try to avoid markets where we're kind of seeing that trend downward. We really do believe that there's going to be some opportunities out there. We're looking at things every day. And while there is a challenge, we do think we're going to have some really good opportunities. So I would expect that you guys will probably be hearing from us fairly soon.
Yeah, thank you, Adam. That was really great. So our development thesis aligns perfectly with our acquisition thesis. We're going to be looking for developments and land acquisitions in the same areas that we're going to be looking to buy existing properties. So I won't regurgitate those same stats because they're in essence, the local and regional markets. So in our backyard here in Omaha, Lincoln has really strong rent growth right now. Des Moines, Kansas City, even Lawrence, Kansas has really high occupancy. And we've been looking for land acquisitions and ground up opportunities in that area. So I want to speak a little bit about kind of the current pipeline that we have in developments. So right now we have an 11-acre parcel under contract in Springfield, Nebraska. So Springfield, if you don't know, has seen a lot of interest because of the workforce and the opportunities or the growth that has happened along Highway 50. So think about the Amazon distribution plant, the Facebook data center, the industrial parks that have been built along Highway 50. And then Sarpy County is also doing a phase 2 of their sewer expansion project. So what this will do is this will allow economic growth in Sarpy County, specifically Springfield. And what we're looking to build is approximately 200 units of that Class B, B- workforce housing. So Jay talked a lot about that particular asset class, and that's what we would look to go deploy in that area. We see Springfield as think of Gretna 10 years ago or Elkhorn 15 to 20 years ago. So a really up and coming area that surrounds the Omaha Metro. And we would like to put in some attainable housing in that particular area. The other opportunity is we acquired 24.5 acres of land at 192nd and Jones Street. So that's directly across from Ravello Phase 1 and Phase 2, our flagship apartmentium, which has done incredibly well. And we're really excited about this new acquisition because we are looking to do 135 BTR or build to rent single family rental homes on that parcel. So for those of you who don't know the single family home rental market, that has been a big boom in the Sun Belt that Jay and others talked about today. And we're looking to bring the first large scale BTR community to Omaha in the next 6 months. So That opportunity will likely be coming out in Q1 or Q2 of next year. And then lastly, to Adam's point, a couple different developers have reached out to us, specifically local churches. So they're not developers per se, but they have land that they would like to build on. And they are looking to do affordable housing, so low-income housing tax credit. Metonic has a lot of experience in this. We actually did a low-income housing tax credit rehab with Onyx Exarban back in 2019. And then we applied for tax credits to do a project in Lincoln. We were not awarded, but we're very familiar with the process. And so what these churches have asked us to do is to come in as a co-developer and help them through the process to put more affordable housing units next to their parishes so that they can either supply housing for people in their congregation or just people within the community. So we're really excited about that too, because 30% of our portfolio is affordable that has some sort of subsidy attached to it. And so we would like to do more of that. I think the last piece of this that I'll just piggyback a little bit on Adam is there have been 3 developers who have reached out to us regionally. So one in Lincoln, one in Des Moines, and one in Kansas City. And they are looking for joint venture partnerships. So this is something that we have had success in the past with great partners. So for instance, on Capriana Homes, we're partnering with Habitat for Humanity to do a mixed income community. We also partnered with Quantum Development on Latitude 41 back in 2019, which has been a very successful development for not only Metonic, but for our partners. And so these more regional developers have reached out to us and they have said, could you help? They have done the heavy lifting on entitlement and pre-development, but they need help with capital, lending partners, raising money from investors, and also the deep bench that Apogee has in the construction expertise. So these are just a few opportunities that we're looking at on the development side. And for those of you who are invested in Gretna Landings, I'll get to that here in a minute.
Thanks, Cassie. And to Cassie's point, we are looking at partnering with others. So if you know through your networks anybody that either has land or is looking to partner in a multifamily development, or just want to make an introduction, we're always happy to listen, especially in the market that we're in right now. So I'm going to turn to Trey. Trey, can you talk a little bit? We've got over 80 properties in our portfolio. Can you discuss Metonic's portfolio over the last 12 months and some of the challenges, but also some of the opportunities that you see in the upcoming year?
Yeah. I think the benefit of going last is Jay and Joel have already provided a lot of my material, so I appreciate that, guys. I think first, on the heels of the debt deal, wanted to just touch on Metonic's kind of loan portfolio. So we got about 90 loans across our real estate in excess of $700 million. As we sit here today, our weighted average interest rate is 3.7, which sounds pretty great. I think, of those loans, 65 to 70 are multifamily loans. In 2023, we didn't have a single loan maturity, and we don't have anything in 2024. So very well positioned in terms of debt across the portfolio. And even add on our construction projects, we have interest rates from 3.25% to 6.3%. Again, no maturities for any construction projects until 2026 and beyond. So we feel pretty good about that.
We talked about Omaha having 4% rent growth. Year to date through Q3, our entire portfolio is at 5%. If we kind of hone in on Nebraska markets, which is largely Omaha and Lincoln, we're at 6.2% year to date. And Iowa's behind that a little bit at 5.4%. So a lot of strong performers within our portfolio. Occupancy is a similar story. When you look at Omaha, very well occupied. We're, a point or two ahead of Omaha occupancy across the portfolio. So we're, again, performing well. Properties, year to date have been very strong. I would say in the future for rent growth, I think one of the cool things that we're going to lean into is some AI assisted revenue management products. So think of that as, when you're booking a plane ticket or a hotel, it's a better way for us to have dynamic real-time pricing across our market rate apartments. So our goal is to have that start to be implemented in early 2024. Really looking for, that advantage, that boost to, react to what the market's telling us in real time without having to wait on, third-party market data or feedback from, other properties in the immediate submarket. So exciting stuff, I think, on the horizon in terms of, how we manage our, not only the rents, but when we're thinking about when leases are rolling over, what gives us the best opportunity when a lease is coming up to go capture that next rent increase. Those are the things that we're really thinking about going forward. I think the other thing, I think you wanted me to weigh in on challenges. I would echo insurance, property tax, and just the cost of CapEx. I don't know that I have a whole lot to add on insurance other than, I will share, I think of expenses on a kind of per unit basis across our portfolio. So this year I've had an insurance renewal in Sioux Falls, South Dakota that was $240 a unit. I had one in Springfield, Missouri that was close to $1,400 a unit. So it is everything in between that, as you can imagine. Deductibles are largely the same. We have everything from flat $15,000 deductibles to other deductibles that are creeping up on $1 million. I think, as we're viewing 2024 and beyond is, it's again being prudent about, your cash management, escrowing appropriately, being realistic about what is happening in the insurance market. Gone are the days of 3 to 5%, budget increases on those line items. We're 10, 15, sometimes 20% on those line items. And they add up for sure, which I think makes it kind of circling back to the rent and occupancy component of being very diligent in how you're approaching any opportunities to go, maximize value. We're still going to do value add plans where they fit. We're still going to look at amenity spaces and tenant experience to go, drive some of the revenue side just to keep up with the insurance. On the property tax side, I would agree. My sense in 2023 was, I think assessors finally feel that they might be caught up. I hope they feel that way. It'd be great. But that was my sense. We help our investors by, finding good partners to help us appeal property taxes is actually a pretty staggering stat. I went back to 2019, and if we add up all the reductions and valuations that we were able to obtain through the appeal process, it's over $115 million in value. You add a mill rate onto that, you're at a pretty good number in terms of annual property tax expense that we've been able to save. And on the CapEx front, it's no different than construction. It's materials, labor, availability of contractors. I think 2023 was a really good example. We were looking at year-to-date actual versus budget. Q1, Q2, early into Q3 looked like, wow, we're really saving money on CapEx. No, projects are just delayed, right? So as we get into Q3, Q4, projects have picked up. It does, locally in some of our markets, it does sound like there's some contractors coming back and saying, I've got some crews that I need to put to work. So hopefully that's better news on that front.
Thanks, Trey. I'm going to switch back to our existing developments. So if you picked up a trifold when you walked in, one of the stats in there was that Metonic's deployed over $190 million in equity over the last 3 years. And a great lion's share of that equity is in our development projects that are ongoing right now. And so you touched on a little bit, Cassie, but could you provide us an update on our existing developments, Gretna Landings and the others that we have going on?
You bet. So our team has been busy, and thanks to all of you, we currently have 850 units under construction right now. So last year at this time, we talked a lot about our Apartminium brand. and that would be Vistera 72 in Papillion, Alora 168 in Gretna, and also Capriana Homes in Elkhorn. So those have been under construction for approximately 12 months. And 2 of those properties currently have buildings opened. So Vistera 72 has 4 buildings opened. Alora 168 has 3 buildings open. And we're very pleased to report that we are meeting or exceeding our underwriting rents for both of those properties. Vistera is currently 100% leased for the units that we have available. And Alora just opened units in September, 3 buildings since September. And that property is about 85% leased or occupied, for the units that we have available there. Capriana, unfortunately, had a slight delay in getting its building permit. So the city of Omaha, we worked with them for about 3 months to correct a life safety issue. And so we're about 3 months behind schedule on that one. So first building will deliver in December of this year, and then we'll work to catch back up on that schedule. So those are going exceptionally well. There was a question last year about our Millennium Apartments that we have in Palm Desert. So this is not a coastal city that Jay told us not to invest in. This is very different, and we're really pleased with the progress of this one. So we have footings and foundations in the ground. We will go vertical before the first of the year, and then we'll have our first clubhouse and building open before summer. So with all the red tape and with all the struggles that California is, we are super proud of this development, and it's going exceptionally well. And thanks to the hard work of our team here. Cool. So a couple months ago, we broke ground on Square Apartments, which is in Midtown Omaha. This is a 73-unit podium style market rate that we got about $1.8 million worth of TIF for. So we are a developer that are putting housing into the market right now in this very troubling time. We locked about a 6% interest rate on that deal, thanks to our partner at Emprise. So we're really excited to be under construction, and those units will deliver in 15 months. But as we talk about challenges, and I'm sure you guys are wondering what we're seeing in the construction market and what are the biggest challenges. So material shortages and long lead times, that has all since corrected since the pandemic. So we've seen that normalize. Things like countertops, cabinets, appliances that were really long lead items, up to 6 months during 2020 and 2021, that has all self-corrected back to kind of normal lead times of anywhere between 8 and 12 weeks. But when we signed the GMP on Square, our contractor went and ordered the electrical gear. And like I said, this is a 15-month schedule on this 73-unit build. And the electrical manufacturer said, well, you'll get your electrical gear in 16 months. So that's some fuzzy math that doesn't really work. And so what we're having to do is go back to our contractor and go back to our electrical engineer and re-specify the equipment and figure out if there's a different manufacturer where we can get that. This isn't just a local issue. This is a national issue that everybody is experiencing delays and really long leads with electrical gear. And so it's something that we're having to be really innovative and creative to figure that out. So do not fear. We will absolutely figure it out on all of our projects. And we have been because we experienced this through the Apartmentium portfolio and even before that. But that's one issue that we continue to see. And then I think the other one is just labor shortages, right? You read about it, you hear about it. It's not a local issue. It's more of a national issue. Skilled labor is very hard to come by. So when you think about your mechanical, electrical, plumbing trades, people are just not going into the labor workforce anymore. I mean, they're wanting to be behind the computer. They're wanting to be in the management positions. And so when we look to contract not only our GC, we make sure we focus on subcontractors who have a deep bench, and they might not always be low bid. They might just be able to meet or exceed our schedule, and that's why we're selecting them. So that's just another thing that we continue to watch for and that we've been experiencing on all of our projects. So Gretna Landings, good news is we are receiving 5 competitive bids on Gretna Landings this week. We will then qualify those bids through those 5 contractors and look to engage in a GMP contract yet this year. So that one is still planning to move forward. We're still really excited about that opportunity, that location in Gretna. We think that it's going to be an exceptional investment. We heard that, and it's now public knowledge, but we heard that there was, for a long time, a mystery shopper that was going to be going in just to the north of where Gretna Landings is at 192nd and 370. And we just found out that it is a hospital. So when you think about housing demand and needs, that is going to be huge for that area and Gretna community in general. So more to come on Gretna, but our team has been working hard to get that one in budget to go ahead and deploy this year.
Thanks, Cassie. Quick side note, for those of you that are invested in Millennium, you probably see the live camera feed. I don't know if we'll ever do that again because there's a lot of pre-construction work, engineering that goes into developments before they get out of the ground, but a certain individual on this panel gets called by one of his relatives almost every day, why isn't there something coming out of the ground yet? So I don't know. When I see that live camera feed, I just feel sorry for that certain individual named Adam. So, I think now is a good time to open it up for questions from the audience. It can be about this panel to any of these individuals or anyone else that you want to ask a question of.
You're in a very unique position in terms of how you staggered your debt to be in the position you are today. So, A, was lucky, I doubt that. So, maybe share with the audience a little bit, how did you set yourself up to be in this position when so many in the industry are not?
Yeah, that's a very good question. So there is an element where we are doing largely Fannie and Freddie loans, which are 10 to 12 years fixed. The prepayment structure it can be pretty penal. So there's an element where Jonathan mentioned Metonic was very active in kind of 2010, 11, 12, acquiring a lot of assets. While the rate environment in 2019. 2020, 2021 did happen to align with a certain section of the portfolio. And then there was another segment where it was, okay, let's take this point in time for what it is, which is, incredibly unique with rates where they were. We have rates in our portfolio that are sub 3%, fixed for 10 to 12 years. So it was doing the math of, all right, we might have some prepay here, but we can reset this for another 10 to 12 years. Our name is Metonic. It's a reference to a lunar cycle. We believe in the cycle. We're very aware that, this will not last. So the strategy is really, keeping in mind each asset's business plan, what debt product aligns with that horizon, and what do we realistically think is going to happen in capital markets and in terms of rents and occupancy that get us there. So it was, we mostly hit on this right as COVID hit. So it was fast and furious for about 18 months. I think since 2019, we've placed close to $800 million in loans. So it was a very large chunk, and our bias is long-term hold. So when there's an opportunity to kind of give yourself more runway, we're likely going to do that, again, depending on the asset-specific plan and strategy.
Then what are you specifically doing as a sponsor as it pertains to your construction debt? Because the rates you quoted are not market rates today.
We're just that good.
I think it's good. I think it's good for investors because there's some form of either structure, relationship, or credit enhancement that you're providing in order to have that kind of construction debt, which again de-risks the investment for those investing. So how are you approaching that?
Really, what we're getting at is guarantor strength, leverage points of each of those construction loans, and track record, I think, is what that comes down to. So I think one of the key benefits of investing with Metonic is, we do provide loan guarantees. So the 3.25% to 6.3% construction interest rates that I'm quoting, those are recourse loans. And we have capacity as a company to help source those. So makes it easier than, a group of, family and friends going out and trying to place, in the case of Millennium and Palm Desert, that's an $80+ million loan. Coming up with enough net worth and financial backing to be able to place that, your pricing on that loan would be higher than our 6.3 for most people. So that is one of the benefits. And it also matters when we're going out and getting non-recourse financing. To qualify for that, Joel hit on that as well, as there is net worth and other exposures that are taken into consideration. Kind of back to the construction financing, I think this has been mentioned a couple times. We're not a group that pushes leverage. There are a lot of developers that will look for maximizing their construction loan, which is typically 75 up to 85% of your construction cost. We are not that group. I think if you took our blended kind of loan to cost across the construction portfolio, we're probably more like 65 max. So we understand there's the construction development risk. You also have some lease up risk on the back end of that. So making sure the investment is safer in terms of having more equity up front and recognizing that, again, kind of back to a long-term bias is having some runway to go capture if and when rates are more favorable to go get that pop and return of equity through a cash out refinance and then get that loan onto a non-recourse option is really our play there.
On behalf of our entire team, I want to thank everybody for showing up today and spending some time. Jay Parsons, Joel Kirstein, thank you for coming into town and shedding some light on the markets. It's really valuable information. Really appreciate having you both here. Follow them on social media, please. And on behalf of the entire team, thank you for being here. If you have questions, come find us afterwards. Really appreciate your partnership.